And if you look at the charts, 2550 is a breakout. But if you listen to somebody like Michael Oliver, who charts momentum rather than price per se, the breakout is about $1 below that, around 24.40. And if it breaks above that on a momentum basis, then you might want to watch for a very strong, quick move of $5 to $10 above that in a fairly short period of time, days or weeks. And that's the sort of thing I'm watching for. Well, there's a practical and an emotional reason why gold and silver really should be looked at as insurance first, profit second. First of all, the practical matter is that a lot of people hold and should hold gold as an insurance policy against the degradation of their other assets, either through the aspect of inflation, which constantly eats away at our paper money, our fiat money, not to mention in times when the stock market is in a downtrend, gold tends to be countercyclical, and after an initial drop, it will tend to rise during times of great discord, like it did in 2009, when it was the only asset, I believe, that year that was up in late 2008 and early 2009, only by about 4%, but everything else was down. So an insurance policy, I think that works very well. I think we're going to be facing big enough moves going forward here in the reasonably near future, going out over several years, that the profit motive is going to be something that people want to consider as well too. I think the potential is there for a very large amount of profit as we move into a very big leg of the secular bull run, which has been going on since about 2002 in gold and silver. And the emotional reason for looking at the metals, especially gold, as insurance is that you will be less likely to sell in a panic because your emotions are a lot less. You've accepted the fact that you're buying it as insurance, and we don't sell insurance the first time that something goes the other way for a little bit. We go, hey, I'm glad I have the insurance. And so this tends to keep you calm, and you don't even think about selling, especially if you're not on margin and if you're not doing futures contracts or something like that. So it serves a psychological and a practical means for holding them. Let me get back in a minute to with the first part of your comment about gold and silver not being too volatile or how volatile. But let me address the price blocks, what I would call price blocks, which are starting to take place now. And it's kind of funny. I just thought of this today, and I referred to 1979 when silver started its move from, actually it had gone in late 78, I believe, from about $6 to $10 or $11. And then it got up around $12, and that's when it really started taking off. And in the process of getting up there, instead of seeing 10 cents either way during the day, you started seeing 20 cents, and then 40 cents, and then 60 cents. And finally, when it broke out and went up from, say, 12 to 20, and then it did several other impulse legs up to 50, the blocks got bigger. So you might trade in a $2 range over a period of several weeks, and then a $5 range. And so I'm seeing the same sort of thing here now. For example, today, silver was down about one point, about 50 cents or so. Now, that's considered to be a pretty good sized move one way or the other, but I think we're going to see a lot of those kind of moves, both up and down. And if you were to draw blocks around several days or several weeks of price action going forward, I think you would find them to be in rectangular formations on the way to breaking out to higher levels. And that's the sense that I'm getting, is that they're building up a lot of energy, which is, this sideways to slightly down pattern has gone on for about a year and a half now. But that energy is building up for a big move. And according to the Bible on technical charting, when the metals break out of a triangle, 2/3 of the time they break in the direction of the preceding trend. So gold and silver are in a secular uptrend now. The odds are 65 to 70% that move will be higher. Sometimes you can have a fake out to the downside, and it could break lower, but it doesn't mean it's going to drop down that much. For example, if silver were to break down in this kind of a pattern, it might go to 20 or 19 or even 18, but it wouldn't stay there very long, I don't believe. But 22 seems to be pretty solid support right now. It doesn't like to stay much below that. So it's banging around between 22 and essentially about 25.50. And if you look at the charts, 25.50 is a breakout, but if you listen to somebody like Michael Oliver, who charts momentum rather than price per se, the breakout is about $1 below that, around 24.40. And if it breaks above that on a momentum basis, then you might want to watch for a very strong, quick move of $5 to $10 above that in a fairly short period of time, days or weeks. And that's the sort of thing I'm watching for. So I want to have enough metal and I want to have enough mining stocks so that I'm not scrambling to get the positions that I want when the volatility increases and the potential price profit starts declining for me by waiting around until the market does exactly what I thought it would do. We're seeing stagflation again here in 2022, and I remember this very distinctly. I think that's where the term was really coined, was in the late 1970s. And that condition was relatively high inflation and uneven business conditions. Some sectors did reasonably well, others not so well. There were supply problems. It was difficult for people to price what something should be because the inflation kept moving things up. And I remember working in a grocery store in the old days before computers and all this during that time. And we would use lemon juice to take the price off of the cans and then stamp it on with a hand stamper. And that was going on quite a bit. Sometimes, every couple of weeks we'd do it again, and even less. And the same thing with little white stickers that you put on. So, and we never really kept up. So the stagflation we're having now is more pronounced due to the huge government deficits and because of personal debts. And so to borrow a term, it'll be on steroids. It's already on that. We're 7.5% on the CPI, came in yesterday. The reality is, on the shadow stats, is probably twice that. If you go to the grocery store or you go to the hardware store, try to find something that has only gone up 7% this year. I think you'll be hard put. Everything I see is 10 to 15% or 20%. And really, the retailers don't even know what the price should be. They just say, well, let's raise it $1. And they're not trying to gouge people. It's just that they don't have a way to understand really what it should be. And we look at the CPI all the time. That's the government doctored figures. But I like what Frank Holmes says about it, how he discusses it. He says the CPI, the Consumer Price Index, is a backward-looking index. The Producer Price Index, the PPI, is a forward-looking index. The PPI is what producers think and distributors think is going to be happening, and they tend to be pretty accurate. They tend to be more accurate. And so I would suggest pay more attention to the PPI if you want to know where things are headed over the next few months at least, than the CPI, which has you looking in the rearview mirror in your own personal and investment planning.